Thank you very much for coming today. We've just done a couple of sessions in Sydney and Brisbane, and this is our last one in Melbourne. But the topic is very topical. We've had the ABC do an article on TV in relation to the ATO and their heavy-handed tactics in relation to debt recovery. I noticed Cor Cordis got a look. DJ, one of your partners, was on the ABC. Accountants Daily have just recently put out a big article on what's going on with the ATO, and today we've got a panel to talk about it from a negotiation point of view and really understanding where the ATO are at and what are the things that they're doing to recoup what some estimate, whether you look at reportable or unreportable debt, of nearly $70 billion. So we'll talk about that. We'll also talk about the legal side of things with Nigel from Aptum. We've got Olga Koskie from Assure, and Matt Kalinski will come up and talk to us about the value of assets and where they're heading. But most people that are surveyed are quite optimistic about where business is at today. They think going forward things are going to be okay. But some of the lead indicators that I look at, and which I'll talk to in a second, don't sort of paint a rosy picture. And I think there's two parts of the economy, some that are going very, very well, but there are also a large part, and some of that's to do with the hangover of COVID, but there is a whole bunch of businesses in major distress. And what we're trying to do with asset-based lending is provide a solution for those businesses, but also some advice here with the people that are around the room. There's accountants, there's insolvency practitioners, there are lenders here. So with everything we talk about today, hopefully you can take something away from what the discussion is and implement into your business and advise your clients accordingly. So KPMG did a survey around what the top 5 challenges for businesses are, and it's quite interesting. It's very much got a technical flavour to a lot of the things that businesses are focusing on at the moment. The number one thing that businesses are challenges that they have are dealing with cyber risks. So protecting and dealing with cyber risks and data. We've seen a lot of organisations, large profile organisations, that not only have an operational risk around the data being released, but it's a reputational risk given some of the brands that have been out there and data has got out into the wide world. And that causes major concerns for brands and businesses alike. So that's their number one challenge for 2024, making sure that's all locked down. When you start to sort of get into that sort of digitalised future, you then have to have the people to be able to first retain and then upskill those workers to be able to deal with the digitised future. So I think there's a lot of focus on organisations making sure that they're all geared up to be able to have the right people to be able to deal with some of those real challenges. And as I said, a lot of that is in that risk space, and predominantly cyber risk space. For the accountants in the room and insolvency practitioners and even the finance guys, regulatory processes and reporting changes are always going to be a challenge for business going forward. Constant change in that space where you've got to be prepared and ready to go to be able to advise your clients accordingly. And there are liabilities for people providing advice if you're not up to date with some of that stuff. So that's the number 3 challenge for most businesses. And as we sort of look at cyber risk and making sure we've set ourselves up for a digitised future, how do you then transform your business and optimise, I suppose, all of that work and effort to be able to get some organisational value out of it? So there's one thing being able to do it all, but at the end of the day, that all comes at a cost, and you need to work out how do you then extract value out of all of that investment around managing cyber risk, getting the right people, the increased cost of regulation and processes that surround regulation. So that is a massive challenge for business. So, and that then sort of falls into that cost control space. And part of what we'll touch on today is the ATO, who is obviously a cost for all businesses. But you've got cost control challenges, and you've also got an inflationary environment where the jaws of both of those two things really create massive issues. So we'll cover a lot of that today in the panel, but they're the top 5 challenges according to KPMG surveys that recently have been done. And I think that's probably synonymous with most businesses that are out there. They're all got those types of concerns. Obviously there are plenty more, but they're the top 5 according to that survey. So I always like to look at lead indicators in relation to what are the statistics that I'm looking at that sort of give an indication of what the future looks like. And Creditor Watch recently put out a report around some of the key highlights from the data that they extract from their large member base. And the overall theme of what they come up with was that trade payment defaults are up and invoice values decline. So how does that all sort of play out? So in business-to-business trade payment defaults, they're 47% year on year up. So that means for all of the invoice terms that people are sending out that subscribe to Creditor Watch, year on year, 47% increase on last year in terms of the number of invoices that are outstanding. So that to me is a massive lead indicator around what's about to sort of come. So it could be a timing thing, but to me that's a slight concern. And I think things like increased cost pressure and all of the stuff that revolves around that, rates, inflation, wages, labour, and everyone hears every single time you turn the TV on around cost of living pressure. And all of that cost of living pressure reduces demand, and I think that's what's sort of driving the reduction in invoice values. So when there's reduced demand, obviously the invoice values are lower, but then businesses aren't getting paid on time. So there's some real concerns, and there's no doubt there's a significant correlation between payment defaults and business failures. And I'll go into some slides in a second, but the number of insolvency events are starting to get to where they were pre-COVID. I've put 24% year on year, but some people have told me that's up to nearly 36%, depending on which way you look at it. But in any case, we're sort of getting back to the norm pre-COVID, but I don't think we're fully there yet. But as I was saying before, there's a raft of lead indicators that will indicate that this trend will continue. So again, I don't have to remind everyone that the industries that are significantly affected, and a bit of it's got to do with the construction contracts that were signed years ago. Construction industry is one of the main industries that have been affected. Those surrounding the construction subbies, suppliers, and all of those sorts of businesses that are linked to construction are being impacted as well. Food and beverage and retail, you only have to walk down the street or any of the strip shops in Melbourne to see the number of places that are available for lease. So there's some real concerns around what's going on in the market, and they seem to be the top three things. And why we're here today and what we'll talk about in the panel is what the ATO are doing to that. So they're all of the day-to-day things that happen within business, but then you've got this overlay of this 50, 60, 70 billion dollars worth of outstanding tax that the ATO are now looking to recover. So just some details on the insolvency statistics. This is from ASIC, but this is the year-on-year numbers, just to give you an indication what that 36% increase looks like. CVLs, Dockers are all up. Small business restructuring is up significantly. That's one of the new measures that the government put in place to help small businesses. I think there's a limit of around $1 million in terms of that. But what we're about to talk about with asset-based lending, we can sort of assist directors with funding to be able to get small business restructures up and going, as well as Dockers. The statistics by state, I think New South Wales is obviously being hardest hit, so the opportunities in New South Wales from an insolvencies perspective are huge. But in Victoria, we've seen some growth, same as Queensland, and that just gives you a bit of an idea. But then you start to look at industries that are affected. So if you're an accountant, you're in finance, or you're an insolvency practitioner, these are the areas that you'll probably see most businesses that are under some level of stress. And obviously the construction industry is one of the biggest ones of those. It's interesting, the government have come out and talked about what their plan is in terms of the number of houses that need to be built or that they'd like to be built over the coming years. And so if this trend continues and there's not some measures put in place to be able to protect builders and developers to be able to get out there and have a real go and be able to deliver on those promises of the government, it's going to be a real challenge. So that gives you, I suppose, a bit of a feeling around the industry, what's happening in terms of insolvency and numbers, and what are some of those lead indicators that give us a view as to what might be coming into the future. So asset-based lending. So asset-based lending has been in operation for about 3 or 4 months now, and so my background has been with the banks for most of my career. I got involved with private lenders that lend against property, and a lot of conversations I had with businesses were, do you take any other assets as security? So obviously most private lenders won't take any other assets with that as security, and I saw an opportunity in the market where we would lend against other assets to be able to help businesses with short-term challenges. And I suppose the first thing I want to say about asset-based lending is don't think about this as a Scott Pack or any other asset-based lender out there. This is nothing like it. I still don't know how I got asset-based lending as our company name, but anyway, we have an industry term as a company name. But But we are asset-based lenders in the truest sense of the word. We will lend against any asset that can be valued. Some of the positive things, and I suppose our tagline says it all, we are fast. We secure those loans, but it's against any asset that you own. And the next dot points that I read out, everyone's going to say, how fantastic is that? But there is a catch, so I'll get to the catch in a second. But any lending that we do, and we'll lend up to 60% of any value of any asset, and I'll explain what type of valuation we use to be able to determine that 60%. But we don't require any company financials. As I said, we are valuing against the asset and lending a percentage of that valuation. No director's guarantees required, no monthly payments required. So if people are that stressed, they need to use their asset to be able to get a loan. They obviously need a payment break. So during the course of our loan period, we don't require any payments to be made. You can if you want, but it's not a requirement. We'll do loans from 20k up to 1 million and funds available within 24 hours. And the reason I can say funds will be available in 24 hours is because we only really need one number to make a determination whether or not we're willing to lend, and that's the value of the asset. So we do a forced liquidation value. We don't do a full market valuation, and we'll lend you 60% of that value. So I'll get into some of the detail around eligibility and how it works. We only lend to businesses. We only lend for business purposes. The asset must be owned outright. For us to be able to register a PPSR against the asset, we need to make sure that we either take the existing lender out or the asset is unencumbered. And this is the real key, and this is why we're a small piece of the jigsaw puzzle. We're not for everyone, because a lot of businesses require those assets to actually earn an income. So this is designed for businesses that are asset rich and cash poor. And there are a lot of organisations, and the accountants in the room would know this, where you go and visit your client, you walk through their yards and there's assets lying around everywhere that they own, yet the next question they ask you is, how do I get finance to be able to fix up a tax debt that I've got? So this is really, so we hold the assets. So our business partners are Lloyds Auctions and Valuers. So Lloyds have 14 yards across the country, and again I'll explain how it all works in a second, but just to give you a feel, Lloyds do the initial valuation. We do a desktop valuation, and then we verify that asset once it gets to a Lloyd's yard. And for the duration of the loan, we will hold the asset, and when you pay the money back, the asset goes back to you. If you don't pay the money back after the 3 or 6 month loan term, we sell the asset at auction, we take our principal and interest back, and the balance of those monies go back to the client. We'll do up to 70%, but as I said, it's really 60% is our number. But obviously, with some assets that we're able to get rid of very quickly, we did a deal recently with a hovercraft. I was not lending anything above 60% because there are not too many people in the market for hovercraft. But yeah, so we'll lend up to 60 to 70% depending on the asset, but 60% is our policy. And we'll also do a thing called managed sale advance. So if you have clients that have assets and they want to sell them, but they need money today, Lloyds will take the asset, do a valuation of the asset, I will lend money against that asset, and Lloyds will run a proper full market campaign. So that is a 4, 6, 8 week campaign to maximise the value and return for the client, but they are able to borrow money day one and, to resolve whatever their short-term issues are. So that you can look at these two ways. You can do that and get money straight away and get moving, put the asset for sale, or if you think you've got a new job coming through, or there's a progress payment due where you need money in a hurry, you're not using the asset, you can set it over with Lloyds, we'll advance very, very quickly. And as I said, we can do that in 24 hours because we only need one number, and that number comes from Lloyds. So the process is, you can get online, everything's online, you can provide all the details of the company, the asset, upload photos of the asset, and once you've sent that and submitted that, it automatically goes to Matt Kalinski and his team, and they'll do a desktop valuation. Costs nothing at this point in time. The desktop valuation comes back to us. We then send out an indicative letter of offer to you or your client, indicating whether we're willing to lend 60 or 70%. And if at that point, if that number satisfies the customer's needs and they're happy with that, they pay an application fee and a valuation fee. And all that's required then is the documents through DocuSign to be sent to them, signed, the asset delivered to Lloyds Auctions. They verify the asset, check VIN numbers. We then register a PPSR against that asset, and then within 30 minutes the funds are in the account of the client. So we're not relying on financials, we're not relying on director's guarantees. We need a signed contract, we need to verify the asset to make sure it's the asset that you said it was when we first did the desktop valuation, but we will have money in your client's account within 30 minutes. So some of the real success stories that we've had is people have been on the wind-up list. They've got 21 days to resolve an issue, before, and if they don't resolve it in 21 days, they go into liquidation. And the liquidators would know most of them are appointed on some of those jobs, and that buys time for some of these businesses. Now, we don't for one second think that this is going to be a solution for everyone, and I probably estimate that 50 to 60% of the deals that we do will probably result in a sale further down the track. But the good thing is there are some positive outcomes with businesses that have a bit of a plan. They might be in the middle of a restructure through their finance broker. They might be talking to an insolvency practitioner around a restructure or small business restructure, or we've even actually funded a DOCA. So there was a business that was going into VA. It didn't have the cash to be able to put the money up front to run a deed of company arrangement process, and there were other assets they were able to use that funded the DOCA, and that business is well on the way to being saved. So there's a whole raft of different purposes for asset-based lending, and as I said, if the company needs the asset to generate an income, then we're not for you, right? So, but if you've got organisations or companies that you work with that need money in a hurry to resolve short-term issues, whether it's cash flow, whether it's ATO, it could be a solution for you if you're interested. We pay a referral fee of 2% for anyone that refers business to us, and I'll provide all of my details later on. Everything you need to know about our business is online. So thank you very much for listening to asset-based lending. I think it's something that no one else is doing in the marketplace, as I said, it's not all things to all people, but it's a very small piece of the jigsaw puzzle that hopefully once people get their heads around it and how it all works, it'll be a solution for some organisations to help buy them time or bridge finance or whatever the case may be. So we're going to jump straight into the panel. I notice breakfast has already been done. I didn't have any as usual, but I'm going to call to the stage our panel members, and as I mentioned in the invitations, we're investigating the ATO's debt recovery plan. And all of you would have heard about DPNs. The level of activity is really increasing. It's becoming a little bit aggressive. I don't think the ATO really care about some of the excuses, but I think with the panel we've got together today, there are legitimate reasons of why you potentially could contest some of these things, but at the very least you'll understand how the process operates when dealing with the ATO, and I suppose what their current views are. So I'll start with Nigel Evans, the Managing Director for Aptum Legal. Nigel, if you could come to the stage. Thank you. Olga Koskie for the tax Assure. Thank you, Olga. And Kalinski, all the way from Queensland. Lloyds options. Have a seat. Olga, you better take the microphone first. You're the star. So we might kick off, Olga, if you could introduce yourself, tell everyone about tax Assure, and we'll start the process that way.
Thank you all. Thank you all for coming. It's a bit exciting to have a full room. We've been doing this all week, but I was secretly looking forward to Melbourne. I'm Olga Koskie from Tax Assure. We're specialist tax debt negotiators. All we do is help with a very, very specific piece of the puzzle, which is the tax debt piece. So we come in and assist where clients have got outstanding tax debt to get them into payment arrangements that they can afford, that aren't going to cripple the business, but are actually going to save them. Ones that match their cash flow, not necessarily ones that the ATO yell at them that they must have. And where possible, we get rid of the interest and penalties, which leads to the reduction of the overall debt. And we do that very early on in the piece rather than waiting for the debt to be fully paid, which helps with LVR when you're lending, also means you're not paying interest upon interest, and it helps with cash flow because you then get a lower payment arrangement.
Thank you. Nigel.
Nigel Evans from Aptum Legal. We're a specialist litigation law firm, and we do commercial and tax litigation. For the purposes of today, the dividing line between myself and Olga is where we step in where the underlying tax debt is in dispute, and not just the underlying tax liability, but also the director penalty liability. So our particular emphasis on tax comes from a background where we've worked with and inside the ATO. So the head of our tax disputes practice, Tuan Van Lee, ran the ATO litigation practice in Victoria. Many of you would know Tuan. Before starting Aptum, I was a barrister and regularly briefed by the ATO. So we come with that sort of understanding the mindset of who we're dealing with on the dispute side.
You didn't by any chance have a career in radio before you got into law? No. Matty?
So Matthew Kalinski, so I'm the head of valuations for Lloyds Auctioneers and Valuers, so the keeper of the dartboard, so to speak. So obviously we do valuation and asset realisation for various clients. Obviously everything from litigation, finance, obviously, insolvency. Look, Lloyds is a national company, 14 yards, as Steve mentioned, around Australia. And the beauty of working for Lloyds in my profession is Lloyds literally sell every asset class. So whether you want to buy a cow or you want to buy a Prada bag or a Lamborghini, we pretty much have a market, buyers and sellers in those areas. So we've always got very intelligent people to leverage from and see what sort of those asset classes are doing. So that's me, right, Joe?
One of the reasons we partnered with Lloyds Auctions and Valuers is, so from my experience at Core Quartus and the valuations that Lloyds have done, is their accuracy. So in asset-based lending, Matty only has to be 30 or 40% wrong before I lose any money. So, and we're pretty confident that that's not going to be the case. So one of the things with Lloyds is they're plus or minus 5% in terms of what they value assets at. So the accuracy is very important to us. Obviously, we then start to get into territory around LVRs that are a real risk to asset-based lending, hence the reason why we partnered with Lloyds. We'll get into it. Olga, can you just explain in your experience what the attitude of the ATO is at the moment and what's their position in relation to negotiations?
So I think the easiest way to describe the ATO's attitude at the moment is all bets are off. They're in active, strong collection mode. They're very, very focused on the term compliance. Now, compliance doesn't mean that you don't have any debt. Compliance means that you're in an active payment arrangement and that your debt is being lowered each month rather than increasing. So what we're seeing more when applications are being made for payment arrangements, they're actually looking at a history of a matter a lot more. So I know that some of you in the room will have had the opportunity to call the ATO, ask for a payment arrangement. When they don't give it to you, you hang up, and 10 minutes later you call again, and then you ask for another one. And then they don't give it to you, and you hang up, and you go to your mate next door, look, I got some terrible operator, can you just do it for me? It's super easy. They try, and then hang up. Where the ATO is sitting at the moment is that's now 3 rejected applications. And so because they have such a heavy focus on compliance and a history of compliance, it's now going to be even harder to get someone into a payment arrangement. And we're also seeing a huge amount of recovery actions. We were joking before about the orange letters and the red letters. The recovery action that's being taken, which I think demonstrates the attitude of the ATO at the moment, is a lot of it is automated. So as Steve mentioned with the DPNs, and I think some stats came out that we've had about 10,000 being issued a month since January, is that they are computer generated, and a computer can't read notes on a file. Now the credit reporting, the ATO has the power to also issue credit reporting for people that have outstanding debt. Again, the computers don't read the notes on the file. So it is a very aggressive approach where if a client is non-compliant, so they've got outstanding tax debt that's not in a payment plan, even if the client's been calling the ATO consistently, if an accountant's been calling the ATO consistently, there could be pages of notes, but the computers, as I said, aren't reading these notes, and so we're seeing huge automated recovery action.
Thank you. Obviously, before you hand that over, but obviously before you get to the DPN, there's a whole bunch of things that happen leading into that. What are the sort of tips that you've got around getting yourself, like before you get to that point, what are the things that you should be doing?
So the biggest message that we're sending is you've got to eat the frog. So, you know, the saying, the thing you don't want to do, you cannot bury your head in the sand. We hear people saying, well, just don't lodge. If you lodge, then they know how much you owe. You've got to lodge. I'll let Nigel and everyone else, so many faces in this room, know the consequences of not lodging. You can't ignore the debt anymore. So the biggest tip is if there is debt, as soon as you know that it's there are things that can be done. And I'm biased, but a very true believer in specialisation. You look at this panel, you look at asset-based lending. I think it's a very difficult space for accountants now to be a one-stop shop and be expected to do absolutely everything that a client who might be in distress needs. So it would be to use specialists to act very, very quickly. And there is a raft of solutions, and that's one of the reasons why we wanted to do this today, because there's a whole heap of options that people aren't aware of that can help clients in a number of different situations.
Thank you. Nigel, I'm just really interested, obviously you start to get into the legal side of things. When you get a DPN, obviously the first thing you want to do is how the hell do I get out of this? And one of those options is to dispute the debt. So if you do want to dispute the debt or the DPN, how do you position yourself to be able to do that, and what are the things that need to be considered when you get to that point?
Well, the first thing to start is to make sure we understand what we're talking about in terms of DPNs, whether we're talking about non-lockdown DPNs and lockdown DPNs. Now, most of you in the room will have some understanding about this, but the non-lockdown DPN is where you've got the company who's complied with all their lodgement obligations, and that raises a raft of different responses when a director receives a director penalty notice. The lockdown DPNs are in a different category, and it's important to think about these from a first principles basis, because you then think about, well, A, how do I prevent myself as a director receiving a director penalty notice, and then of course how do I respond to it. The first point is obviously precisely what Olga said, and that is to lodge, and companies need to lodge. And we're not just talking about PAYG obligations, we're now talking about superannuation and GST as well. So, and that's critical because, as we know, a director at first principle is liable for a company's taxation obligations. So that's your starting point. When it comes to the ATO recovering on those taxation obligations, they can turn to the director after they've issued the director penalty notice. And this is where the non-lockdown and lockdown becomes quite important. If the company is lodged, then the director receives the director penalty notice, and then we're in that space of the 21-day response that Steve alluded to before. Now, if you're in a space of challenging it, that's a very hard space to challenge, because usually you're not in the space of disputing the underlying debt. You've already got the debt on the table, and usually what you're doing is reacting to the non-lockdown with the state of remedies. It's really about, how do I meet this taxation obligation? Do I consider payment arrangements, or do I consider the other options? The harder part is in the lockdown DPN, and that's the circumstance where the company's failed to lodge. And when you're wanting to challenge, a director's wanting to challenge in the non-lockdown space, in the lockdown space, the options are extremely limited, and it's very difficult to challenge. But there are options. The primary one around lockdown DPNs is the extent to which that director has been involved in the management of the company. Now, that's the starting point for that is, of course, every director is supposed to be involved in the management of the company. Every director has a primary obligation to ensure that a company is complying with its taxation obligations. So you can immediately see that the way in which you dispute a lockdown DPN is difficult right from the outset, because the ATO is expecting a director to perform their duties. When we're looking at disputes of lockdown DPNs, we're looking at two things. Firstly, around the validity of the DPN. Has the ATO complied with their procedures? Olga's reference to the automation processes that are developing now are creating more fertile ground for arguments about the invalidity of the DPN. That only takes you so far, of course, because it just knocks out that DPN and another DPN can be reissued. So the real critical aspect is, well, me as a director facing a lockdown DPN, what steps can I take to try and avoid this liability? And that's about running arguments to say, well, I didn't really have anything to do with the company at the time this tax liability arose. There are statutory defences. It is, I wasn't involved, and it's usually out of illness, but the statute does say, or other reasons. And it's the other reasons that are critical. So when someone comes to us in a lockdown DPN situation, the first thing we want to understand is their history and involvement with the management of the company. We want to understand what role they played in their taxation obligations. We want to understand what role they played in trying to get the company to comply with its taxation obligations. One of the critical examples we've been involved with recently is an example where one director was perpetuating a significant fraud, and it was a fraud on the ATO, and then the other director found themselves being hit with lockdown DPNs. Now, in that circumstance, we were running defences to say that person was excluded from the management of the company by reason of the fraud. that was a novel argument. It's a difficult space. But essentially, to prepare yourself to challenge these things, you need to have a really good understanding about what involvement you had in the management of the company. And of course, the best thing you can do is prevent these by making sure you take your director responsibilities seriously.
Great, thanks, Nigel. Maddie, Lloyds do a lot of work for insolvency practitioners, and I had the slide up before around construction and some of those industries. Can you give us a bit of a flavour around what's going on with assets and maybe talk to some of the underutilisation that you see of people that own these assets that aren't being used?
Certainly, Steve. I mean, that graphic that you had up there before kind of describes what we see happening. The one thing, obviously, that graphic doesn't show is the tightness in each of those industries in terms of the wait times for assets. So you have construction, or might have logistics. Even though there might be some difficulty in some of those industries, there's still such a long wait time to get new assets that the asset prices aren't coming down as quick as the industry is facing difficulties, because it's basically the slack's being taken up relatively quickly. So there are a lot of underutilised assets, but again, everyone's a little bit shell-shocked still from COVID. So people who might be had difficulty sourcing those assets are then, might be having difficulty parting with them, thinking that they're going to be going through another 2-year wait to replace them. So they're holding on to them longer than they used to. Used to be able to put it on the market, we'll put it in an auction, sell it, buy it when we need another one. But and we're talking about different assets, whether it's logistics or whether it's for hospitality. At the end of the day, people are just going to put it in an auction and forget about it and lose a fair bit of money. But manufacturing as well, you might have a 2-year lead-in sometimes on some machines coming out of Germany or medical equipment as well. So there is a lot of that, and I suppose that's where ABL fits in beautifully, because those people, they won't be parting with the asset. They might move it, relocate it, but it's still theirs, I guess. We'll give them a bit of a surety. So
thanks, Maddie. You're doing my job for me. Much appreciated. Just before we pass it on, cars through COVID, used cars in particular. Obviously, the cost of them went up. Where are they sort of landing now with the supply chain sort of opening up a little bit, or are they not?
Things are getting back towards normal, still far from normal. So if you're still buying a tier 1 car, let's say you want to buy a RAV4, or you want to buy a 300 series, or even a Ford Everest has the Platinum might have a 12-month wait. So there's still a lot of wait times for a lot of certain brands, but there's been a lot of substitution. So we know obviously the strength of the Asian manufacturing, the Chinese brands in particular, have really picked up a lot of the slack. We've got really good quality cars coming out of China now that people are happy to buy. They can come with long warranties. So we've had a shift in the balance of sort of the purchasing consumer behaviour basically, and that'll wash out in the next 2 or 3 years when those cars come on the second-hand market. We'll see what happens, whether or not they're going to hold that value, or people are just going to go, well, I don't want that. I can get a German car now. I don't want a Chinese EV. I can get a Toyota EV now that just came out. So. But I mean, I won't use a car as an example. I'll use a truck as an example, and it's a local company here. So Kenworth, tier 1 truck, at the height of COVID, it got to 25-month wait time for a truck, which used to be 3 months. And just as a little tidbit, a Kenworth is built in 1 day. So once you get your name in line, you get to the front of the queue, you can watch your truck being built in 1 day. So that went from 3 months to 25 months. As of last week, when I spoke to Kenworth, down to 15 months. So, still gives you some idea, and the change of for your business in terms of having to plan forward to obviously asset acquisition and contract and all the implications you have therein.
Beautiful, thank you. Olga, let's get back to our favourite government body, the ATO. The good old days, Olga, you used to bring the ATO, you make an offer of 10, 20, 30 cents in the dollar. What's the position now around reducing that and being able to negotiate a timeline in terms of repayment? Can you give us some insight there?
So the ATO don't actually do deals. So for some people in the room, they will for you. So only in an event of insolvency can you do a deal. And that's the only way to get rid of core debt. Whereas if you're not going through an event of insolvency, you can't just do a deal. So the amount of times I hear people say, Olga, you just got to tell them, just ring them up and just tell them. If they don't take my 10 cents in the dollar, I'll go broke and no one will get anything. They say that a lot. It won't work. They don't care. So even if you say, well, no one's going to get their paid super and I've got employees for this long, the ATO don't do deals. Their KPIs are not around collections, they're around compliance. And so what they're actually looking at is moving things from their desk within a 28-day time frame. Now, it can move to a different pile. It can move from the non-compliant pile to compliance, which means they're in an active payment arrangement. So once they're in a payment arrangement, they're compliant, and you effectively disappear off the radar. So for the lenders in the room, I'm sure you'll all nod that as soon as a client is in a payment plan, the options for lending to them go through the roof. You've got so many more options once they're in that compliant payment arrangement. The other way that you can reduce the debt is by getting rid of the interest and penalties. Now, at the moment, it sits at 11.25% compounded daily. Again, for the maths people, the brokers and lenders, you can do the maths quicker than me. But 11.25% compounded daily is huge. So they're not actually a cheap small business bank, and they're very specifically saying they don't want to be used as a small business bank. So as Nigel was saying, when you go back to first principles, the ATO look at the whole debt, including the interest, as part of the debt. It is not an automatic right that when you get to the end of a payment plan that you can just ring up and say, "Hi, I'm all done, can I have my interest back, please?" That won't happen. An application has to be made, matching the legal practice requirements with what's gone on in the client's world with the debt to get rid of the interest and penalties. But those interest and penalties are huge, and often we're able to reduce a client's debt by over half by getting rid of the interest and penalties when you go back over the life of that client's file and they've had lumpy compliance.
Thank you. Nigel, you're obviously involved in disputes, and a lot of that's with the ATO. Can you tell us a little bit about what their attitude at the moment when you are in dispute with the ATO? What sort of responses are you getting?
I think it's important to pick up on what Olga said, that, and this is not really a change in the dispute space between pre-COVID and now. It's always been the case that the ATO will only settle disputes on what they would call a principal basis. So the important thing from a disputes context is to understand the mindset of the ATO, and that is that they have a certain policy imperative to collect tax, and the idea that, as Olga was saying, you can come to the table and say, well, I can't pay the tax, therefore we should cut a deal, doesn't work in the dispute space either. So there hasn't exactly been a different trend in the dispute space. That underlying principled approach is consistent. I'd probably suggest it's more rigorously applied now in terms of the requirements on the dispute space. I think one of the interesting trends, and it's an irony of the ATO activity at the moment, because there's so much ATO activity on the debt side, it creates tensions on the dispute side. So on the dispute side, the ATO just doesn't have the resources to cope with the amount of debt activity that they are initiating. So we're in this weird space where there's an acceleration of activity around debt, but more and more delay around disputes. So one thing that we've noticed is the engagement with the ATO on the dispute side, just getting someone to talk to, for example, when a court proceeding's been initiated by the ATO, is nigh on impossible for some time. So there is this weird irony at the moment that once you're in the dispute space, time sort of slows down, and if anything, time's slowing down more than it did before COVID. So no great difference in approach, but certainly from a procedural thing, things are taking a lot longer.
Yeah. Olga, if you can take the microphone, just how that plays out. You read articles about the ATO issuing 50,000 DPNs in one day. Obviously, that is a significant amount of workload back on them. So in practical terms, with your negotiations with them, how long does it take to talk to someone at the ATO? And when you do actually get to them, what sort of timelines are you able to negotiate in terms of a payment arrangement? And where do they sit with all of that now?
A lot of our work is not just a 5-minute phone call. So when you're dealing with the DPNs or other debt, depending on a whole raft of things for a client, is which debt team is looking after it. So there's a whole heap of flags and a whole heap of things that sit behind a client's account as to when there is a debt, whether it's a significant debt, the director's assets, how long they've been non-compliant for, whether the debt keeps increasing. So the majority of our work is not phone calls. The majority of our work is written applications that don't get put on the portal, but the ATO have a magic fax line. And if the guy who's looking after the magic fax line, he's been on holidays for 2 weeks. So when he goes on holidays, the fax houses won't go through. But that's how applications generally get lodged. But for part of the work, because it is building the relationship with the debt team, our staff can sit on the phone for 1 to 2 hours before they speak to people. Most matters that we're involved with, where we resolve them and get them into an active arrangement within a month. Our work is done, and then they go back to the accountant or whoever is looking after their general compliance. And we're still able to get long-term payment plans. So we're still looking at around 3 years for a payment plan. Majority of payment plans, we won't do upfront payments at all. The difference to those two things is once you've got a DPN or a statutory demand, we're still able to negotiate a payment plan, but they usually have shorter terms. And once they've got a statutory demand or they're even closer to the wind-up list, then you will need an upfront payment. The ATO standard line at the moment is they want 30 to 50% upfront, and they'll only give you sort of 6 to 18 months. But with the right applications, we're still having a huge success in the 3-year plan.
While you got the microphone, I talked a little bit about reportable and unreportable debt. Can you just give your feel around what that number is and the magnitude of what we're talking about? Because we've just discussed around the cost of the interest in relation to the ATO, and we all know a lot of businesses use the ATO as a small business lender through COVID, and now it's all coming back to roost. But what is the reportable debt, and what do you think it is?
So I think the stats flying around that I read this week is that the ATO reportable debt sits at 53 billion, and that's about double what it was prior to COVID. There's a lot of talk that the unreportable debt is actually 70 billion, and so that includes all the returns that haven't been lodged. So if a return hasn't been lodged, there's no way to calculate exactly what that amount is. Now that makes a lot of sense, because I think people got a bit confused during COVID, and the word deferral didn't mean disappear. And so when they deferred their all tax obligations for 2 to 3 years, there was this magic thing at the end where the ATO said, right, COVID's now not even a thing. They will not take that as a grounds on its own. There needs to be a whole heap of factors around that when putting a submission in. And whatever accrued over that period of time is now due in full and payable immediately. And so even the debts that we're dealing with, probably pre-COVID, I would have said the average debt size for our team to look after would be around 300,000-400,000, whereas now the average debt size we're looking after would be between 800 and 1.5 million. Most of the debt that we're seeing.
So Nigel, worst comes to worst, the DPN's issued to the client from a legal perspective. Part of the reason I've got you on the panel is free legal advice to everyone in the room. What do you do? What's the first thing you do? And obviously call your lawyer or call whoever, but can you give some advice as to what the accountant should do, or to the client if they're getting the DPN direct?
Yeah, obviously I'm not giving advice.
No.
Again, it does depend on whether it's non-lockdown and lockdown. Non-lockdown, you're in an entirely different space, and what you're really in there is a financial and economic space. So that 21-day period is all about how do I position the company to pay this tax debt? How do I deal with this in a way that will, if you're wearing your director hat, how do I deal with this in a way that makes sure I don't incur the penalty? But that's really more of an economic conversation than it is one of a legal one. You've got a short space of time. You want to be jumping on that and dealing with it in a way that engages with the ATO on the primary tax debt, but also with a view to understanding how that can crystallise as a penalty for you as a director if you fail to take certain actions within those 21 days. On the non-lockdown side, you've got more time. That doesn't mean you should take your time. Again, going back to what I was saying before, I think the first thing to do is to understand as best you can the circumstances that led to you getting issued the DPN. Now, that's not often an easy task, because we're finding people being issued with DPNs in relation to tax debts that have long passed, and even in circumstances where things such like companies have gone through a DOCA arrangement, and then directors are being hit with director penalties for liabilities that everyone understood or thought they understood had been resolved through the DOCA process. So the first thing is to try and get an understanding about what the hell this penalty is about, how did the liability arise, and get as much information as you can about the circumstances about that tax debt. Again, that's not often easy, particularly in companies, small companies, where there's multiple directors. And often these lockdown directed penalties occur in circumstances where there is a small company where there is more than one director and one director has been the dominant force, and other directors really don't understand or know what's going on, and then they're hit with a monstrous personal liability. So the first thing is dig deep and understand precisely what the penalty relates to. And then the second thing is to ask yourself the same questions about debt and whether it should be paid and under what circumstances it can be paid. And then, of course, the third is to come and speak to a professional about, well, these are the factors that I was facing at the time this debt occurred, and it might be that you were absent for illness or whatever reason. Document those, create a clear chronology, get it all set out, and then go and talk to a professional about whether there's any available defences on that lockdown.
Thanks, Nigel. Olga, just quickly, you tell a story about behind the curtain in terms of what happens with debt and whether it disappears or not disappears. Can you talk to us about that?
So I made up that term, behind the curtain. I think it's a really easy way to understand when the ATO classify debt as non-economical to pursue. So there's a lot of old debt around. I haven't seen them do it recently, where someone says, well, and the ATO determined they're not working, there's no returns, there's no income, and they will classify a debt as non-economical to pursue. Now, the ATO use the term written off. Now, if I ask all of you in the room what written off means, you're all going to tell me the debt disappears. But a non-economical to pursue debt sits behind a curtain. And then when that taxpayer, if they ever lodge a return again, or they earn $1 of income, the non-economical to pursue debt magically reappears. It reappears with interest and penalties from the date it originally occurred. And so what people often believe is that it's been written off and it's no longer there, but it comes back and then it's immediately due and payable. The other fun thing we're seeing at the moment, and I've got 2 matters like this where clients have been through DOCAs and have been through the VA, but the debt is still sitting on a separate integrated client account. So at the moment, often most people only have one. We've got, as I said, 2 matters where they've created a column effectively called an integrated client account 6. Now the debt, and one of my clients sits at 5.6 million. He's been through a DOCA. It's completed, it's finished. However, that debt is still sitting there, even though the ATO is saying, oh no, it's not recoverable. It hasn't fully disappeared yet. He's a bit of fun because he's already gone and got another debt after going through the DOCA at 550,000. So we're back in to try and fix the 550,000 when the 5.5 million is supposedly gone. But what this is doing is, again, that it's the history and the compliance. So because they're sitting there, even though they're on different columns in different accounts, the ATO is now keeping that real historic record about what's been happening with that client, and it's going to be more difficult. But he tried to get himself into an arrangement. He said, I rang him up and I just told him how good my company is. They didn't really care. I said, yeah, I don't think they will. And so it's going to be harder. We'll be able to do it, but it will be harder to get him back into an arrangement for that new debt because these old ones are still appearing.
Great. Maddie, we're going to just go last questions along here and then we're going to open to the floor. So if you've got any questions, just get them ready and we'll get going. Matt, there's been one of the good things about Lloyds is the breadth in terms of the type of assets that you value, and some I'm interested in some of the big wins that Lloyds have had. I saw some big numbers reported for the #1 number plate in New South Wales and Queensland. So can you tell us a bit about that and some of the stuff that you see?
Certainly the #1 for New South Wales, I think it might be the 3rd highest grossing licence plate in the world. I think the record was 18 million or something in Dubai. We got 13.5 million for #1 New South Wales. It was the first time that plate came up for sale in 100 years. We did Q1 as well, which sold for, let's say 6 million-ish. I haven't got the exact numbers. 6.5, yeah, and that's probably a plus buyer's premium as well. So very expensive license plate. So when we talk about money in the market, and there's plenty of money for good assets. So obviously, yeah, and the beauty of being at Lloyds, we see some of these classic cars. I mean, good Australian muscle cars are still doing really well. And we're still getting some really high prices. Unfortunately, for fellow panellists, some of the American imports and things have fallen off the nose a little bit. So someone might be in trouble in the family. What more can I say? Look, certainly good assets, and I suppose in manufacturing and maybe in the yellow gear as well, yellow space. Good name brands with low hours are still getting very, very high numbers, but as soon as they get the hours up, people are getting more and more choice now. So.
Well, that's a good win. I'm doing the calculations on the commission on those sales.
Who knows the
only issue we've got, Matty, is which cars Steve's going to put them on when he gets them home.
And how's the insurance premium going to be?
Yeah.
Oh, it's on the plate. It's actually
the
right to
security guard
display.
as well,
Yeah, it's a right to display. Who's got Melbourne? I heard you can't have Melbourne 1 because I think the first 3 Melbourne ones are government. So who's got Melbourne 4 in this room? We'll get you good money right now. We've got ready, willing buyers.
Nigel, can you give us a win that you've had recently that you can share with the group?
Yeah, I want to do one very quick thing before just picking up on what Olga said. The issue about director liability and company liability creates this really ambiguous space about who you're advising. So advisors in the room need to be super conscious of this because the advice, particularly accountants, are giving to companies about lodgement has repercussions for directors. And in this space about dockers, for example, there's a lot of directors who think they've resolved the underlying tax debt when they're then met with a penalty in a lockdown. So I just thought that was worth mentioning. On the win side, we recently acted for, I mentioned it earlier, some unfortunate directors who found themselves in circumstances where another director had perpetuated a very substantial fraud. And we ran this defence about non-involvement because they were effectively excluded by reason of the fraud, and that's led to a really successful outcome. So that was a great win in a space where there's not a lot of case law, and it's a really difficult defence to run.
Olga.
We had a large vet surgery come to us, and their accountant had tried to get them into an arrangement in December. They owed the ATO $450,000. They needed to draw funds from an overdraft for some other growth. They were getting another surgery on board. And the ATO had said to their accountant that the only arrangement they could get was 30% upfront and a 12-month arrangement, and they needed it done in 2 weeks before Christmas. And we were able to get them no upfront, 3 years, and no payments over the Christmas period because it's really, really quiet period. So it was a staggered arrangement which assisted with their cash flow. Once they're now in a compliant position, so we'll wait 3 months, there's about 120 of interest and penalties sitting on that account. So we'll be able to go back and clean that up for them as well.
There's a story you told in one of the other sessions in relation to a family, and it was an example of why the ATO would give some sort of concessions to certain businesses. If you could share that with the group.
Yeah, so that was a really sad story, and most of, I would say 98% of our clients, bad things have happened. There's a lot that goes on that people don't talk about in this world. This client was a concrete pouring company, and the wife did the books, and the husband managed all the concrete pouring. They had 8 trucks on the road, and their 3-month-old baby died. I always get goosebumps. And so when their baby died, she stopped doing the books. And of course, why is she lodging basses? I can imagine she can barely get out of bed, let alone lodge any basses. And so what happened was the staff that worked for this family obviously kept working, so money kept coming in, the trucks kept going out, and they had a huge GST bill after 12 months. And so what we were able to do, and then they started to get all of the orange letters and the red letters, they owed a huge amount of GST, and we were able to wipe that immediately because of the circumstances that had affected that family, and also get them into a long-term payment plan. So it was nice to be able to help people like that. But I think their story, and one of the things we say to people when we're talking and getting the background for these applications is, do you have any children, and how many children do you have? And the pause that then came with that, and the information we were then told, I don't think I'll ever forget.
Yeah, very sad. We're going to go to questions now, so I'm opening the floor to anyone wants to ask any of our panel members any questions.
Before you mentioned, do you hold the asset, like every yard, or they get to keep using the asset? Like
No, we hold it. That's our only form of security at asset-based lending.
Against chair or something, so if I use that as security to finance, do I not get to...
No, we need to physically hold the asset for the duration of it. Yes, we do. Yeah.
Okay, so that
Yeah, knocks out a lot of people. We're not everything to everyone, but if you've got assets and you are sitting there doing nothing that you own, it's a possible solution to give you some cash flow in a hurry.
So technically they're non-performing assets.
Yes.
Just sort of sitting there
That's right.
collecting dust.
Absolutely. Yeah. Question over here?
Yeah, I was just fascinated with the DOCA nuance as it relates to tax debt. So, I mean, is there a legal foundation to that not getting expunged off the register with the ATO? Because as a former banker, I'm slightly stunned.
It really is. When you think about the underlying principle behind director liability, it's a parallel liability. The idea that there can be some form of compromise, and indeed the ATO could be voting on the DOCA, and some form of compromise that doesn't extinguish the director debt. It feels like there's something wrong about this.
Yeah,
so there's a bit of a watch this space about how that might unfold over time. But the other policy reason here, of course, is all of this armoury of activity around the ATO, the things like DPNs, guarantee orders, now credit reporting, and ultimately what might come in things like not allowing deductibility on interest. It's all about creating an environment where you're complying, where you're lodging. So the other policy purpose behind this is, well, if you haven't lodged, then bad luck. That's the consequence, and you're stuck with it. So it's sending a message around the importance of a director being responsible for a company meeting its taxation obligations. So that's the competing policy purpose. Honestly, I don't know how this thing will unfold over time, but it's definitely inconsistent with the idea of parallel liability.
Amanda.
Olga, at what point in time is the ATO lodging defaults against a business? Like, what part of the process do they push that button to lodge that default?
So they're allowed to lodge that default if the debt is more than 100,000 and more than 90 days overdue. So there is no flow chart, so to speak, of exactly when a recovery tool should be used. So it's a little bit like a Wheel of Fortune. They've got all these great recovery tools that they can use, and in any one point in time, they can choose which one. So if it's 100 grand or more than 90 days, they're at risk at any point. But whether they're going to do that first, or do a garnishee first, or do a DPN first, or do a statutory demand first, or do a red letter first, no one really knows.
So is the default being lodged by this automated process, or is it actually being lodged by a human who's making a decision on the debt or on the situation?
No. So the reporting that goes to the Credit Reporting Authority, it's our understanding that it's automated. We've had a number of clients that have been in the process that either themselves or their accountants were talking to the ATO, but they weren't in an agreed compliant payment arrangement, and the computer doesn't read the notes. So even though they were in that engagement talking process, that's not enough now to stop it.
Yeah, so we've talked today about avoiding the worst scenario, being DPN, how they, whatever, when we do have the worst unfold. So the director, you can't manage it, you can't get out of DPN, you're in a situation where the director is personally liable and doesn't have the money to pay. Is that then just straight into bankruptcy proceedings?
That would be someone probably all in this room. There's about 10 people, I reckon, that'll pounce on you as soon as we finish. But that wouldn't be for us to talk about.
Yeah. As I advise myself, but we have got now a few live where it's going to get to that point because there's just no way we're going to get up. There's a DOCA in play, the director liability, there's personal guarantees. It's going to get there, but we're intrigued as to how long it will take to get there. When you have so many tax office rhetoric saying we're going to use every recovery action possible to make this happen.
So we've seen them very quickly. So we've seen at the moment, and this is just my personal experience, statutory demands or expire and then they're in the wind-up list within 2 or 3 weeks. Or when we're speaking to people trying to buy extra time, that the file's already gone to legal. So for those that read the wind-up list, you might see batches at the moment. So sometimes there are trickling through of when the ATO have started wind-up proceedings, or you're seeing the big batches. So there could be a delay if they're waiting for a batch to go to a different panel firm. But we're seeing that action move quite quickly at the moment. But I don't know any formal directive about the timeframes in between those steps. But the advice that we would give is as soon as that statutory demand expires, you'd expect wind-up proceedings very quickly at the moment.
And I think on the insolvency side, it's about getting advice. Olga talked about dealing with specialists around before you get to that point, knowing it's sort of getting down the track. Because I think from an insolvency point of view, the earlier you get to it, the more solutions you have available to you. So I'd suggest you sort of speak to someone in that space, and I'm sure they'll all come running over here as soon as this finishes. Paul Jantz. Yes, there you go, another option. Paul.
Mate, thanks first of all, for finding out more about ABL, so thank you for everything you've done this morning. Olga, I've got a question for you. Can you deal with a client, let's say they've already gone into a payment arrangement, they're compliant, but the arrangement, not the deal, the arrangement is just killing them from a cash flow point of view. Is that something that you can help with, Viv?
Yeah, absolutely. So we're doing lots of those at the moment. That arrangements have been agreed to because it's just easier to say yes than try and renegotiate or get a better one. And then they come across and there's a whole heap of nuances behind the scenes as well. So when you cancel an arrangement compared to an arrangement defaulting, and then when you renegotiate a new arrangement, there's different flags and different ways it affects a client's file. So we do a lot of work where we come in and renegotiate to help cash flow, a better arrangement that matches cash flow, a longer arrangement. And what we usually do at the same time is we get rid of and clean up the interest and penalties with a detailed application. So not only is it a better arrangement for cash flow during the next term, but you're starting from a lower base. So that also is reducing the amount, and then you're not paying interest upon interest. And depending if you want to borrow as well, that's helping LVRs. So yeah, we're doing a lot of those at the moment.
Well, ATO has got clear guidelines for remission of GIC.
Speak up a bit. I can't hear.
ATO has got clear guidelines for remission of GIC, general interest charge. We have been applying for remission for clients who are under 100,000 or over 100,000, and even though they have clearly fulfilled the guidelines, still ATO has been rejecting lots of our clients. What's your advice? Yeah, what's
Sorry, was it under what amount? Sorry, under 100,000.
100 and over 100.
So the majority of our applications to get rid of the GIC would be 10 to 12 pages long. They're not paragraphs on the portal and they're not phone calls. So the way that they're written is my background is a commercial litigation lawyer, and we're not an accounting firm. So the way our submissions are written, they respond directly to the legal practice requirements that the ATO set out. The client's circumstances, the dates, the timelines, and then they match up completely with the legal practice requirements. So it's not it's not just a 10-minute phone call. It's not just a quick. They were affected by COVID. They lived in Melbourne and now need their money back. That won't fly and won't work.
Any other questions? We're going to be hanging around for the next 10 or 15 minutes if anyone's got any specific scenarios, but if there's no more questions, we might wrap it up there. I think we've just gone slightly over time. Thank you very much for coming today. I'll just go through the panel. Thank you, Olga. Very much appreciated. And Nigel and Matt Kalinski, thank you very much. Really appreciate everyone turning up today. Hopefully you've taken away something that can help you in your business. We're going to run these series throughout the year and come up with different topics to try and add value to our relationships and referrers. So thanks again for coming, and we'll see you next time. Thank you.